Okay, traders, we have a lot to go over, so I'm going to just dive right into it. So the first thing I want to share with you all is that I have updated the HPMRs, and they are in the room drive, the futures room drive. I make these available just to you guys. We create a Forex pack, a futures pack, and stocks. I sent out an alert with the list of symbols that are in the packs, and they work only on Thinkorswim right now. That's just the way that it works. So most of our members have Thinkorswim or Thinkorswim and TradeStation or some kind of combination. So if you don't have them, don't worry about it. But wanted to let you know that these are in the room drive, where to get them, where to import them. And where is the room drive? There is the room drive right there. It's an icon within the chat room that you can open up, and there's a lot of different indicators and files and things that I make available exclusively to Futures Room members in that drive. So it's a handy thing to refer to, and a lot of the things that David, Neil, and myself will share will be in that room drive for you all. So that's to kick that off. Now you might ask, wait a minute, Rog, we're bringing back HPMRs? I mean, I thought we weren't doing that. Look, about once every other week since the volatility went berserk, I've been pulling the HPMRs, creating the newest calculations from the data that we have from AutoChartist, and checking to see if price action is in some way sort of normalizing, if AutoChartist is catching up to the volatility. And I would say that today's HPMR, the most recent update that's in the room drive, looked about as good as it's looked in probably a couple weeks. Now, we'd have to keep an eye on this. It doesn't mean that we're always going to work within this framework of historical volatility, but this is about as good as it looks. So I went ahead and pulled it, ran the indicators for y'all, and we'll talk about this tomorrow in the chat room. I don't know whether this is the week we officially bring these back, but I have been checking on them. Now, the thing to remember about the HPMRs is when we get sudden increases in historical volatility, well, then a tool that relies on a certain steadiness in historical volatility is not going to necessarily be as accurate as we would like it to be. But because a tool like this is always looking at the new data and factoring it into the old data, at some point, one of two things are going to happen. Either the data catches up, and therefore the historical data has enough of the new volatility to be more accurate, or the volatility contracts and works better within the older, more narrow historical volatility tendencies. So one of those two things are going to happen. Sometimes it's going to be a combination of both. Nonetheless, we'll go check them out the remainder of this week and see if we're going to bring this back in a more serious way. All right, so that's first of all. Okay, second of all, I'm getting a lot of questions about, Rog, what do we do in an environment like this? And here's the thing, gang. I've been through this a number of times. I know many of you have as well. And there are certain tendencies during this time. So think of this as a potential cyclical recovery. And, even though '08 doesn't necessarily encompass all of this, this is where I do want to at least share with you all some of the things that I've noticed in the past, because you know what? Here's the thing. Everyone's going to have an opinion on this. There's no doubt about that. But very few people have actually traded through these things. So I think for those of us who have done it, it's kind of our job to kind of talk about the 2008 playbook versus today. So I'll be definitely getting into this more as we go into this week, and even as we go through the remainder of this month. But let's talk about what we've seen in terms of recovery. Right? Because that's what everyone wants to know. Where's the recovery going to be seen? And I just going to call this the recovery order. In other words, in what order will we see the recovery? Well, I don't know what we're going to see, right? We want to steer clear of prediction and talk about probabilities. All right? So what order will we recover? And so what I mean by that is, where do we typically see which major asset classes? Because this isn't about stock picking, gang. I mean, you could do a little bit of that, sure. That I would say is maybe second or third down the line. But which major asset classes recover first, right? And then we'll go into which sectors you can kind of put that into the asset classes, which sectors, and then we go into which stocks. Okay, which stocks. So, and even which commodities. I would actually put that which commodities ahead of that. Okay, so the first one that we're going to say is which order. Normally, whoever goes into economic turmoil first is the first to come out of that. So in this case, who fell first? Well, who fell first is going to be who gets up first, typically. And that's going to be typically emerging markets, gang. In this case, and I think it happened in 08 too, emerging markets comes first. And then you're going to see things like, and this is why I know a lot of folks are asking about high yield corporate bonds. High yield corporate bonds will come back. All right, those are going to be your first and second. So then after that, typically, and this is not one people think about, but the Russell, the small cap, will come back. Then the S&P 500. Okay? And then you get things like investment grade bonds and things like that. And that's really been, you shuffle up these three, whether it be Russell, then emerging markets, then high yield corporate, or whether it be high yield corporate, then emerging. Typically, you're going to see those three. Those are the top three. Okay, and so we also expect these to get hit hardest first. These are the ones that get hit hardest first. By the way, that also means when these start coming back around, what could that then be a signal of? Yes, the bottom, right? The bottom. So it's not only about how to put your portfolio together. You may say, Rag, I'm not doing much with a portfolio, and that's fine. I have someone else manage it for me or whatever. But if you're starting to ask, well, how do we know when the bottom might get put in? Who fell first? Who's going to recover first? And again, when you go back to say 08, 09, and this is usually how it happens. Okay, emerging market, high yield corporate bonds, Russell, those three, and not necessarily in that order. I think that 09 played out that way, 08, 09, but again, it's going to be one of those, one of those three starting, and then the other two will follow. Okay, so then you think about major asset classes that recover first, which sectors, which commodities, which stocks. But let's just start here. All right, I don't want to get too far into this because we're too soon. It's just way too soon to be talking about this. But that's the way typically we will look for not only a potential bottom, but we'll also look for opportunity to rebuild portfolios. Right? Now, I do want to touch on sectors. Which sectors? Because that at least will explain why I'm looking at a few sectors right now. And it might be a little early, but you're going to notice tech is going to come back. Then basic materials are going to come back. Then you're going to notice consumer discretionary. And it doesn't have to be in this order. What I'm actually sharing with you guys is typically the percentage gain. This is an order of percentage gain. And then real estate. And then you'll get the S&P. Now, again, this is in order of percentage gain, not in order of chronological order. Okay, and again, it might shuffle up, but it's typically going to be that kind of combination. Not always. I would look at consumer discretionary, and in this case, in the case of 2020, in this case, I would focus on energy. You notice energy wasn't listed there. I think energy is going to be a big one. I would focus on energy. I would focus on materials, and then I would focus on likely real estate. That's going to be a big one here. I want to see real estate come back, and then I'll focus on consumer discretionary. And if you think about people's habits, how are we going to reemerge from stay-at-home orders? It probably makes sense when you look at that list. It may not be perfectly chronological, but I'd say that's a really good look at that list. I've been getting this question a lot. There is a high level look at it. High level meaning some altitude, right? I'm not trying to say we're getting academic here in any way. High level meaning let's take a good, 20,000 foot view of this. Not I like Amazon or I like Clorox, right? Not that. Too soon for that, right? Those are trades. That's not how you rebuild a portfolio. And talking about portfolio rebuilding, still a little too early, because I still believe that these names are getting hit hard. So I hope that makes sense. And think about that in terms of patience. And actually, additionally, in terms of patience, we're always going to be data driven in this room. I'm not going to succumb to, well, this looks really interesting. No, I'm not going to do that at all. Yes, I kept CNBC volume on today, which was just such a bad idea. This is interesting because this shows you the bounces that we've seen back in '08 between September and December. So do I think the bottom is in yet? No, I think we could see 2 or 3 rallies like this. We're not going to see an exact mapping of this behavior, but do I think we might see 2 or 3 rallies before we put in a new bottom and then start to put in the bottoming process? Yes. Do I think it might take 2 or 3 months? I think it might take 2 or 3 months. Sure. I hope that we're not, and I mean this because I don't want to see people get, annihilated by this market. I hope that's not where we are. I really hope this is where we are. So at the end of the day, even though I do want to profit from a down market, I know what down markets do to people. And as much as I know that I'm much better in a down market than in an up market, down markets make a lot of sense. Up markets can act very unusually. I hope we are near the bottom in some ways because, let's get back to work. This is going to be, I think, a generational opportunity to put capital back to work. If people are patient, if they're patient and realize we probably haven't put the bottom in quite yet. All right. Those are some of the popular questions that I've been getting. Now, let's talk about some of the trades. I have XLF on the brain. I have XLK on the brain as well. XLK was that trade we wanted as the NASDAQ traded up into the 7880 to 7900 area. Now you might say, whoa, what happened today? The market rallied towards the end of the day, I believe most likely on 2 pieces of news. News is not macroeconomics, gang. News is psychology. News can be a lot of volatility, but we had 2 big pieces of news. And I think the one that kind of was floating around all day was the fact that the White House is telling Wall Street executives that there might be another $1.5 trillion in stimulus by the end of the month, so round 4. The other thing that I think really caused the rally at the end of the day, this thing right here, was OPEC Plus, meaning Russia, is likely to agree to cuts. Remember, Putin is in the driver's seat with this whole, process of cutting and will they or won't they. He's opened the door. He's open to discussing cuts, which is something that the shale and the Saudis really need. The Permian Basin and the Saudis really need it. OPEC Plus is open to agreeing on cuts as long as the U.S. joins. Because remember, when OPEC and OPEC Plus were cutting before, those production cuts, who was wide open throttle, red line on production? Just full on. Wide open throttle, the U.S., the Permian Basin. So I think the Saudis and the Russians would like to see, if they're cutting production, they'd like to see other players, especially major players like the Permian Basin, the U.S., also cut as well. So interesting there. And could this create that rallying crude that I want to see to short into? Remember, gang, it's not all about the secret squiggle, right? It's all about the V-score or the wave or the propulsion dots and so forth. I'm waiting for this news of OPEC and OPEC Plus to rally the market. And then am I in my resistance zone? Is my downtrend still intact? That's going to be the timing. So timing of the event that could create that catalyst, that launch, that catapult higher. And then we'll take advantage of technical levels that are available to us after the psychological catapult, if you will. Okay? And it's not that different probably for the S&P and the NASDAQ either. My S&P zone was between 32 and 70. I sent that out as an alert. In that zone, we can price SPY puts. We can get short the ES. Just be aware of the risk that you are willing to take. You might choose to go with the options because you can manage risk. Another way that I was looking at this would be potentially through names like Visa, right? In other words, an alternative to shorting the SPY, the ES&P, would be let's short the banks, XLF, into the rally, or even Visa. Now we had the XLK alternative for the NASDAQ. So that's all this is here. That's all this is here. And remember, we want to scale in, not pile in. little bits of size going in to the trade, small size. Tomorrow we'll look at a lot more of these potential moves and where else we might be able to take advantage of the rally, as I feel we are trading back up near the top of the range where we can short again, following many of these double red. This is what I mean by double red, the trade flags for the 8, 13, 21 exponential moving average and the 34 EMA wave coming up into that top of the range, and then we'll build our shorts and take advantage of the movement back down. For those of you that are wondering why not buy, I don't want to go counter trend. If you want to, you know where the bottom of the range is, and you're more than welcome to buy calls, but I would rather just kind of root the bulls on here, root those buyers on, because they're the ones that are going to deliver to us the opportunity at the upper end of the zone. So I don't mind being one-sided. I don't feel the need to get the long and the short of it. I feel much more comfortable day trading the long side of it, like we talked about today. I sent the alerts out. Excellent currency confirmation. You know, we had a couple rough days, I admit, with the bond and the yen narrative. Today, it was spot on for stay long, get long, be long. That's the organization we want to see. That's the organization I hope we have tomorrow when I'm with you all in the room. But in the meanwhile, I'll day trade the counter trend of the daily, and I'll wait for the upper end of the zone that we can get short in again. And hopefully we have a lot more of these to talk about tomorrow. All right. And now, of course, I will be sending out alerts and updates and charts, and I hope those have been helping. And I'll see you in the next update.